Welcome to the CIO Update from Emirates MBD. I'm Gary Dugan. Two stories to talk about this week. Firstly, the tax plans of Donald Trump, which has got risk assets particularly excited. And secondly, movements in the bond markets, where we've seen some very good performance from the high yield market, which we believe is probably coming to an end, and the emerging market debt will be the preferred asset. So let's just start with Donald Trump's tax changes. Well, these were announced last week as phenomenal, which suggests that in the next 2 to 3 weeks, we're going to see something quite major in terms of proposed tax reform. Now, how should we look at these? Firstly, we are somewhat concerned that those tax plans will never see totally the light of day. So maybe only 20 to 30% of what is planned will be implemented. A few reasons for this. Firstly, the budget deficit to GDP is already high at 3%, so there can be no significant giveaway by government. Secondly, debt to GDP for the whole economy is over 100%, and many in Congress were voted in on the promise to the electorate that they would reduce that debt. Thirdly, there are many other things that the Congress are having to focus on at the moment, particularly the repeal of Obamacare. So there will be probably some phenomenal announcements, but it may take some time for these to be implemented, and hence the initial excitement that we expect over this next coming month may start to peter out. So whilst there is still some upside in equities, be careful that you could get caught holding on to something that then sees falls as we go into the back end of the second quarter. Now turning to bond markets, we've had some very good performance from bond markets, particularly risky bond markets over the last 12 months. High yield debt spreads have come down to really 330 basis points, which means that we're probably looking at the full extent of that performance in the very near term. There have certainly been lower spreads, as low as 240 back in 2014. But remember, spreads were as high as 800 basis points just a year ago. So it looks somewhat risky to continue to persist with this asset class, given that strong performance. We prefer emerging markets, where spreads today are around 340 basis points against long-term averages of 350. And emerging market countries in general are delivering a generally good backdrop to places like India, more détente, shall I call it, between the leadership of both the US and China in just the last week has got people more comfortable with Chinese debt. And in Latin America, we probably had a flow of good economic news of late. Possibility of further small cuts in interest rates around the world in the emerging market bloc gives good support to emerging market debt. So maybe time to consider taking profits on high yield debt and switching into emerging markets. So in broad terms, good news still to come out of the US, but be careful of being caught buying into risk assets after they perform so strongly. And if you're staying with fixed income markets and want to take some risk, emerging markets are preferred. Thank you.